All right, traders. Sam here from Tradedevils.com and TradeDevilsIndicators.com. Now, today we're looking at our backtestable median Renko and UniRenko suite. So before we get into some of the unique features that we built into this, let's just talk about Renko bars, or bricks as they're more commonly called, just for a second. Now I have in front of us here, this is a July 21 crude oil chart, and I've got a 7.2 median Renko brick size on this. Additionally, I have our initial balance indicator on here, which I always use just to kind of frame the day, or the RTH, so we're not just floating out in space on a great chart. So you can just get a sense of that framing. And then additionally, I have our toolbar, our custom toolbar up here, because I'm going to use some of these tools as we go through some of this just to demonstrate a few things. So now, Renko's long been appealing to traders because of the potential smooth lines that they create here when the market's trending. And because we're price-based and not time-based, the advantage is that it can eliminate some of the chop or the noise or just the sideways trading that you'll often see in the markets, whether it's overnight or just in a slow day. So our goal here is try and stay consistent with when we're in a trend. Now this effort to reduce the noise by their design is a little bit of both their strength and their weakness. And let me try and explain that to you. So looking at this chart, right, if we focus in here on the RTH here, framed by the initial balance. The first things that really stand out at you are the wicks. Right now, I make a point of emphasizing the wicks. I want them in a bright white, and I want them a little bit fatter, because the wicks are the market talking to you. These are important. If you were looking at this on a very small, like a 233 tick chart, these would look much more substantial than they are, right? This would look like we did something like that. I mean, that range right there from the low of that bar to the top of that bar is 11 ticks. Now it takes 13 ticks to turn the bar to turn the brick around because of the 7.2. So I'm making an assumption here you have a basic understanding of how Renko bricks are formed. But in a 7.2, just for a quick review, the brick size is, we've got a 7-tick brick size, 2 ticks in the same direction to get a new bar. So to turn this around here, I'm going to just use my little measuring tool down here, I do get, if you can see it down here, I get 2 ticks to a new low, but then I get a reversal bar. So the bar has to come back from that low, right? We got 2 ticks, but we didn't carry on. So I've come all the way back here, 13 ticks to give me a new bar. Now I get another 2, another 2. Now here I only get 1 back down the other direction. All right, so you get the basic idea. And these wicks are important, right? So that's why I want to emphasize them, because these are essentially real-time support and resistance. So the market has pulled back here. In order to create that wick, the market, something has happened. The flow of the down move has changed, in this case temporarily. But you'll see it right when we get into sections like this. This is the kind of section that will just kill a Renko trader. And now we've done some things here to try and accommodate the Renko trader to reduce the potential to get chopped up in here, because those are big swings, and that's kind of where I'm going with this, trying to emphasize the potential kind of deceptive risk that is in a Renko bar. So if let's say you're in this trade here, for whatever reason, you took the break of this, or we start here, or maybe we get a lower high. And so for example, let's say, you took the break of that low here. So you take this, and now you're in the trade, and it's going your direction, so you're looking good. Now, about the time that we get a couple of pullbacks here, but let me just demonstrate this to you. So if you're in this trade right here, and let's not assume you got the perfect entry. So maybe you got if it was moving fast, you could have been filled right here, because again, since we're not time based, this could have happened in 1 second. So let's not assume a perfect fill. Let's say you got a little slippage here as well. Now the kickback, as I will call these, or I call them kickbacks, the kickback in that wick right there is 7 ticks. So if you took the entry here, looking to get short, pretty quickly you're underwater. Now that may not be enough to panic you, but right off the bat you're underwater, so you might be thinking twice about the trade. Well, it gets a little bit more severe as we keep going down. So you might be in this trade again. Let's assume you're short here. Now we get to about here. Well, so you're 7 ticks ahead in this trade. Now, if you're a scalper, that might be enough for you. You maybe got 2, 3, 4, 5 lot. You got your 7 ticks, and you're looking to get out. But the real appeal to Renko is that you want to get into these trends and stay with them. So, for example, this little trend here ends up going to, before we get a reversal, we go, if I include the low, that's 32 ticks from your slippage entry up here at the start of the move. But along the way, you had multiple, right? You have multiple points here, and this one in particular, where you're in the trade and you've got, that's an 11 tick kickback. So you're in that trade, and while after the bar closes, you see that it stays red. You could have been uncomfortable or potentially now have gotten out of your trade because you didn't like the look of it. So for example, if you took the trade here and you were trailing a stop or moved your stop to break even when you got 7, 8, 9, 10 ticks ahead, it just takes a little kickback here and you're stopped out, and then the move continues. It's very deceptive to the eye, and I make a point of kind of drawing your attention to this because Renko is very deceptive. It looks very easy after the fact. So look here. So okay, all right, we had a little consolidation, then we start to move higher. Oh, terrific, right? Okay, I take the break out here. I'm going up to the high. Well, hey, I got another 32 ticks here. All right, we had 34 down here. I got 32 up here. Right, good. You're done for the day, right? You're trading your 3 lot. Nice day. Well, yet again, right? So if you're in this trade, that little kickback there is going to cause you some concern because that's again. Well, this one is a 10 tick kickback, right? It's not enough to flip the bar, right? So here we get the flip, and then before we carry on, it's not enough. But as that bar is forming, you could be uncomfortable there because you're unsure. Again, it's always easy with Renko after the fact, right? Because even though we were threatening to reverse down here, we didn't get far enough to create the red candle, and up we go back in that direction. So these little areas, right? So I want to draw your attention to the wicks because these are problematic to the Renko trader. Now, if you're in a 7-2, even something like this, if you were perhaps you were late to that entry, and you've got that pullback, well, that pullback, you might think, oh, wait, it doesn't look so big, right? Well, that's an 18 tick pullback. So you just it's deceptive. I just want to emphasize this because the risk in trading Renko bars at this size, and 7.2 is that's one of the smaller sizes that you might find if you're using our tick size calculator, which we'll get to in a minute. But a 7.2. Right, so here's a good example. So you might think, oh, red bar, I'm going to sell that. Okay, so here we go. Now what did we get here? You only got 1 tick here, so we don't get a new bar. So now we kick back to that 12 ticks. Right, you probably stopped out there. Now, if you're long, then we go into that same series here where these big wicks are potentially problematic. Even though you look at it and say, oh, big deal, right? If you just stay long here, we didn't get a red candle. Great, right? You got the whole move, right? As long as I don't get out here because I don't get a closing candle, I got my 30 ticks. When you're trading it on the hard right edge, right, and you get that, right? You don't know. Right? Is it time to get short? Is this move over? Right? You're not sure. So I'm trying to emphasize that because I think the biggest hurdle that most people run into when they start trading with Renko bricks is that risk is deceptive. So having belabored that point, I want to show you a couple of things that we've done to try and reduce that risk. So your first thought in terms of risk reduction might be to just reduce the bar size or the brick size. So let's do that and just take a look at it. So I'm going to go into the data series, which certainly you can do. So you might say, oh, 7.2, I don't like, that's too much risk for me in crude, or could be the ES, or it's even bigger. Let's go down. Let's go to a 4.1. Okay, so we can just apply that. Let's see what that looks like. All right, so same day, right? So obviously you're going to have a whole lot more of these little swings because it's so much easier to turn the bar around. So if I come back to that section here, and I would point these out to you. So these, in actual fact, more pullbacks is not necessarily better. Yes, it reduces the risk, But if you're in this on the hard right edge and you get that, you don't know that that's coming, right? You could see this and you just don't know. I mean, it could look like this, right? Where you've got this and are we turning down? Oh, now we're going up. Wait, what do we do? It's not necessarily better. These pullbacks cause you to second guess your trade, and so what'll happen, and I speak from much experience as I've been trading Renko bricks for more years than I can remember, and I still trade them every day. This kind of a thing is what creates so much confusion for you because you don't know, right? It's always easy after the fact. Oh, what's the big deal? I'll sell it when it goes red again. These kind of little chop sessions here at these smaller brick sizes, you can eat $500 there. If you're a 2-lot trader, you could be down $500 in the blink of an eye there. I mean, in 10 minutes, right? You could be in trouble for your day. So much of what we've done is really work to reduce some of the problems that are inherent in Renko and maintain their advantages, i.e. the smooth lines and the noise reduction. So let me pull that off here a bit. The other thing that can be problematic when you go to these smaller brick sizes, because we're not time-based, these moves and swings and this kind of action here where it's swing we're changing colors, red, green, these can happen within seconds. Now if you have a volatility in the market, you can't keep up with it. You'd be making quick decisions without really having time to look at it because it's happening so fast. I've tested this down to very, very small brick sizes. It's simply untradeable. You don't have time to evaluate the market because this swing here can happen within that could be 5 seconds, and now you're going back the other direction because it's just a little spike of volatility. You don't come down here and go, oh well, that took 1, 2, 3, 4 minutes. Oh, I had plenty of time to evaluate. This could be 4 seconds, another 5 seconds. It creates problems. So then you come back to it and you think, well, I'll just go back to that bigger brick size here where I get those nice smooth lines. So I'll go back to our 7-2 here. Let's go back a day here and just kind of look through this. And you say, and kind of the same thing. Oh, okay. Well, look how nice is this, right? We know the market doesn't move in straight lines. So here's swing, retrace, swing, retrace, swing, retrace, swing, retrace. Now we go the other direction, swing, retrace. Right? Looks so easy. These are the problem spots. So there's only so many ways that you can approach this, and we've thought through every variable we could in terms of trying to help the Renko bar trader. We're Renko traders ourselves. So there's a couple of different things that we have built into this tool suite to try and help you deal with changes in volatility, as well as trying to identify where the chop comes in, other than, right, it's always easy after the fact. Oh, well, see, you look at it and say, well, I wouldn't trade that. That's such choppy. But when that's on the hard right edge of the market, you don't know that that's coming. All right, of course, right? It's always easy in hindsight with Renko. Always easy, right? When you're in the middle of that, you don't know what you're doing. A couple of things that we've done to try and reduce that risk. Well, number one, of course, you can always change the brick size. But then the immediate thought is, well, what brick size do I use? Right? If it gets more volatile, if it gets less volatile, if the market gets slow in the middle of the day, does that mean that I'm changing brick sizes throughout the course of the day? Well, that's certainly one scenario. But then it becomes a question, well, which brick size do I use? So we tried to alleviate some of that by making it more fact-based or volatility-based by using some mathematics to help us identify an appropriate brick size for the volatility that we're currently experiencing. So let's take a look at that. Okay, so you'll see here now that I've added to the chart, I've added our TDU Renko brick size calculator and then our Renko bar status, which will demonstrate and give us the exact price points at which we will get either a continuation bar or a reversal bar, right? Very handy with regards to stop placement or if you were looking to add to a position, right? So that's going to run on every bar. So you'll see where it will reverse based on your brick size. Now, that said, let's circle back to the brick size calculator. Now, what we're doing is approximating a 1-minute chart, and we're giving you both a fast, medium, and slow ATR reading. So we're working with a 21, 84, and a 36. So it's 4 times, right? So 4 times 21, 4 times 84 gets us 336. So you get the idea. So in this particular case here on crude, the lowest that we go is down to a 7.2. So with that applied, so we can look here on this particular day. Now, the market is closed, of course, since I'm recording this on Saturday. But were we in the midst of, say, the inventory reports or something where the volatility is going to be very high, you will see these changing as the ATR increases or decreases. Now, 7.2 is the lowest threshold that we go to. So if you were looking at that saying, well, I don't want to trade a 7.2. Well, of course, you could manually change it. As I showed you earlier, we could go to the data series and you could pick whatever you like to your heart's content. There's a lot of experimentation that I think is the right way to approach this with regards to brick size. But I will tell you that 7.2 is effective. If you go below that, then again, you get into you've got less risk but more chop and more break in your trend, which can be problematic. So we use a 7.2. If you want to go below that, then I'm going to encourage you to consider the other brick size that we have built into this. We'll get there in a second. But if we go to a 7.2 here, based on this, now you always have the choice. Now in this particular case, all three are showing you the same thing. But during the course of the day, you might see a 7.2, a 9.3, and an 11.4. So you've got to choose which one you'd like to use. I will almost always defer to the smallest one to reduce the risk. Because, so for example, if I went to, let's say, let's just go up 1 to a 9.3, and you might think, okay, well, let's see what a 9.3 looks like, and this might be something you do in the course of your experimentation. Well, we sure did reduce the number of swings, but the risk here has now increased with the reduction in the number of swings. So you look at that little kickback there. While it looks like, oh, what's the big deal? Right? We had a little kickback. That's 17 ticks, right? So if you're a day trader, if you're trading with 20 plus ticks stops, well, not a problem. I'm going to make an assumption here. The majority of people looking here to trade crude wouldn't be using 20 tick stops, right? You typically a max, well, I shouldn't say that, but everybody's different, but you might be trading with anywhere from an 8 to a 16 tick stop, right? If you're trading multiple lots, it can get expensive if you're getting stopped out. So you can imagine at a 9.3, if I've got that much kickback here, even the wicks themselves can be more than you can sustain comfortably. So while the trend, right, if we look here, it's just green all the way up. Again, those kickbacks, very deceptive. Here we get one green, then we go right back to red. So just that range right there, from the lowest to the highest, again, it's 18 ticks. You're in a 2 lot. Well, so you could look at this and think, oh, wow, man, I've hit the IBO, or we are not quite to the. Oh, yes, we are. So I've got the IB low. So you might think, oh, I'm going to get a move back to the middle of the range. Well, up you go, and then quickly you're right back down, and you get a reversal on you. So likely, if you took that long, you might have gotten a scalp out. But with that reversal, now would you be quick to reverse that? Maybe. All right, it always looks good after the fact, right? Oh, wait, no problem. I'd take the stop and just reverse, and I'd make back my money. Always easy in hindsight. It's a little more difficult in the real time in the price action as it's happening. So here again, you should be noticing what's happening at the IB levels. Right? If you're not familiar with what happens there, be sure to go watch our IB video. I think you'll find that very enlightening. But you see this little kickback here. That's 20 ticks before we continue with the trend. Right, very, very deceptive to the eye. You go bigger than that. So if you had, for example, if you had this on a more volatile market, so if you had our brick size calculator and you're trying to trade Renko on the NQ, you could have a 35. The ATR might suggest to you, based on our formula, a 35 tick brick. Now add to the 35 the amount of risk or the number of ticks that would be required to reverse that bar. Well, you could go 30 ticks and not reverse and go the other and continue on in the same direction. My point being that traditional Renko, it needs to be respected when you're in the heat of the battle, in the midst of the trade, because that risk is very deceptive. So let me go back to a 7.2, and we'll just keep it there for the time being. Again, here where you'll see, okay, in a 7.2, here's where I get a new red bar. Here's where I get a reversal green bar. Right? It's very handy when you're in the market. So with all of that said, now let's look at the other bar sizes, or brick types is the better way to say that. The other brick types that we're offering to you if you're a crude trader and 7.2 is beyond your risk tolerance. So stand by, let's go look at that. So of course we're giving you two different brick types here. The median Renko that you're looking at now, as well as the UniRenko. Now the difference is relatively simple, but it's let me put on a UniRenko here and show it to you in the data series. All right, so let's go back here. Now the difference is that with the UniRenko, I get another variable. So I have my brick size, I have my reversal size, and I have my trend threshold. If I switch back to a 7.2 here, you'll note in the data series I have only two: brick size and trend threshold. Right? How many before I get a new bar? Right? So we're adding into that another variable with the UniRenko. That's what makes it a unique Renko brick size. So you might say to yourself, well, 7.2 is too much for me, but I see that the ATR is suggesting the 7.2. I just want to go down a touch. So my suggestion, what I trade, right, was this, and I trade this very, very commonly in both the S&P, the Dow, and in crude. I'll go to a 629. So again, just to clarify, now I've gone from a 7 to a 6 brick size. My reversal has now moved to a 9, and I've got the same trend threshold. So I've just cut it down a little bit. But now look what that does to the bars. So I still get the nice trend when I'm in it. Right? So we can see here, right? So from this pivot, if you took the break of that low, I've got my nice smooth line here. I get smooth lines here. But what it does is it highlights these areas of consolidation a bit better, which is why personally I prefer the UniRenko. Right? It's just a personal choice, and it may require some experimentation for you as a trader to come up with what you're most comfortable with. But what you'll see here is because I'm reducing the amount of range before I get new bricks, you will more commonly get the consolidation areas emphasized here by the chop. Right? You see it over here. It's the same thing. These are what we are trying to eliminate. We're trying to, as a result of just the way Renko bars are formed, reduce. Well, let me say it differently. Highlight these areas of chop so you can make the distinction between them. When we get now, of course, right? So again, same issue, right? When you're trading it on the hard right edge, all right? Do I have 3 new bars of a new trend, or am I just going to a higher area of chop, right? Right. Once it's rolling again, this move here, it looks like, oh geez, it took like just a couple of minutes. Well, because we're not time based, that took about 20 minutes to make that move there. Now it's a nice move, but it's deceptive to the eye, right? So there's 17 ticks, but it took 20 minutes to get there. It looks like, oh, we popped up. There we go. I draw your attention to this because as a Renko trader, I'm trying to identify for you what are the challenges when you're trading with Renko. Now, that's one of the things that we've done is given you a different bar type to choose from, i.e. UniRenko, and then different settings. If it's a slow day, I might go down even smaller than that. I might go to a 417. What you'll notice, right, is that here we were able to get the whole day into a 7.2 pretty easily. Here, I got to compress the whole thing. So you see here what was nice smooth lines here, right? This could be too much chop, right? So as you look at that little swing, you say, oh, that's a nice little swing. Let me show you that, right? It's important to put some ticks and dollars with that. Well, that's 5 ticks before we end up going. We go back here. We go 10 ticks the opposite direction. So you're on the hard right edge. You know, am I a buyer or a seller here? I mean, you could easily talk. You say, hey, well, I just hit some support here. Looks like we're going to bounce here. Okay, I'm long. Right, and that can happen. That could take 20 minutes or 20 seconds. Right, again, because we're not time based, so it makes it difficult here with these smaller brick sizes. Again, it can move. It just can be too volatile. There's no certainty. Well, certainty is the wrong word. We never have certainty, but there's less of a sense of, am I in a sustaining trend here, right? So that, I mean, that looks great there. Do I stay with it? Do I reverse? I mean, these are the challenges all traders face. But what we're trying to do is identify these. So for crude on a typical day where you have, the more common volatility that you would anticipate in a crude day that wasn't either being influenced by international events or macro events or some sort of supply demand event, could be the inventory report, would be the obvious one. All this little chop here can be very problematic. So for a 4-1, if I were at a 4-1 in crude, it would be a very, very slow day, because I'm concerned always when I go to the small bricks of that kind of thing, right? You could eat through $300 or more right there because you don't know. And again, that could take, well, in this case, it takes about 10 minutes. Right? You don't know which way it's going. Now, of course, we can use other tools and other, whether it be support and resistance, a fib swing, or some momentum indicators. There are other tools that we can use to try and help us there. But I just want you to be really clear, and I know I'm dwelling on this, so that you understand, because I don't want someone investing in our tool suite here and saying, "Good God, these Renko bars are untradeable. They're so volatile. The price is moving up and down. I have no way." I'll show you some ways that we've been able to help you with that. So in addition to the brick size, let's go back to something more commonly that I would trade if I saw a 7-2 down here based on the ATR, which, as I just said, I'd be looking at a 629. It's one of my favorites for both the S&P and in crude, which are probably the two markets I trade the most. I want to see this consolidation. I want to know that's happening. Now, in addition to that, we have, if you were reading this off of our website page, let's just bring this back here, and the features that we've built into here. So in addition to the back testing, which we'll get to in just a second, the status lines that we talked about, the brick size calculator, the multiple types of Renko bars, well, we also offer to you the paint bars. Right? Now we use our own formula, and as you probably have heard me talk about this, we use an efficiency ratio here to determine trend. So let me pull that off here, because I want to come back so that as you're reading through this, I want to be sure that I've touched on all of this. So on the paint bars, again, same idea. We're trying to eliminate areas of, let me rephrase, we're trying to highlight areas of consolidation so you can eliminate getting yourself caught up into some of that chop. So I'm going to move over here where I've got them applied. So I'm back to the median Renko, so you can see this here. Just draw your attention to what we're trying to do. So strong trend. When we're in trend, we get the blue bars. When we're in downtrend, we get the red bars. Let me fatten those bars up here a little bit. All right, and the other thing you'll see here, I'm going to make the wicks. I'm going to put them in white, and again, I want them fat and with a 2 width, because I want them to stand out, because the wicks are the market talking. So here's the same thing that we were just looking at in the 7-2, but now I've added our paint bars. So this section up here, what you'll note here is we have loss of trend here. So trend, obviously, we pull back here. Now note, I don't just immediately, as you would in something over here, I don't just go from green to red. Here I have a transition. Let's get back here. Here I have a transition. So here's that nice strong move here where I'm all blue. But then I go into consolidation here. I don't have downtrend strength yet. I have consolidation. I have, essentially, what I have is uncertainty in the market, right? Are we going to keep going higher? Is this just a little pause and off we go? But what you'll note here is we have these color-coded so that you can't get to a red bar from a blue bar without passing through either, in this case, we get both consolidations here. We get the maroon and the light blue. So I have down closes here, but I don't have enough momentum to trigger the bars to turn red. Here I have potential now for the trend to continue, as you would see here. So here's going from the light blue into the strength of trend. Well, here it was threatening, but it doesn't get there. It rolls over. Now again, we can't go we can't get to blue to red directly, right? By design. So here, one more bar, I might have gone red, but I get a little kickback. I don't get far enough to go to dark blue. Here, now am I going red? Now eventually I get to red. So I've had a strong trend up, and this is so typical of crude. So from the opening, I go up. I put it, in this case, this is ends up being my initial balance high. Then I go straight down. Right? It's very very typical in crude. So that's why I'm using crude as an example, because one, it reverses so commonly throughout the course of the day. But what we're trying to do is get into the meat of these moves. It's not an aspiration to try and get tick high to tick low. You don't even want to try to do that. Nobody does that. What you're trying to get is the bulk of that move. So if you got 20 ticks out of that move, you ought to feel good about that trade. If you got, same thing here, if you got 18, 19, 20 ticks in that move, that's a trade to feel good about. Now again, I'm out here at the 7-2, so you can see here, just by changing the colors of the bars and adding in our efficiency ratio to define that trend, I'm able to stay out of the chop. Let me be a little bit more specific with that. It might be tempting to get in there. So to stay out is a function of whether or not you build into your trading rules that you only go long when I have blue bars. Now that may or may not be your particular trading plan. I only go short when I have red bars. But I'm showing to you the way our paint bars are designed to help you identify when the market's pausing and when it's trending. All right, we go back a day here just to. Then we'll switch the bar types. Now, a couple of things you're going to see here when I reduce the brick size or switch to the UniRenko. Same thing here. Remember, we can't get from blue straight to red. So in this case, I go, and I can't get from red straight to blue. So as I go from this, I transition in this magenta color before I get trend. Now I get a kickback. Again, I can't get straight to red. I've got to go through transition. Now I got trend. And just as I was discussing, the purpose of that is to get you into the strength of the trend. Well, there's 14, 15 ticks to the IB low. Kickback. Now, am I going back here? Am I going to go blue from light blue to dark blue? Doesn't quite make it. Right, reversal bar, but I don't go right to red because I can't get there. I've got to go through blue, and then I got to go to magenta. Now I'm in red. Now this is the move I want. Well, you say it was same thing down here, but look, we only got here. What'd you get? Maybe you got 8, 9 ticks before we go into what we're trying to identify and avoid. Chop. I don't have blue or red there. I've just got my transition colors here. But when you're in these moments of transition here, this is a bit of a heads up. Now we'll look at some other tools that we would use to identify potentially a reversal here. But this is not something you want to be trading. Now you might say, okay, well I just take them when they're blue. Okay, well there's 17 ticks. Again, you don't know when it's right there if you're going to get another bar. You don't know. Oh, right, that can happen in a second and a half, right? And you stopped out of the trade. But if you did that, if you were disciplined about it, say I only enter when it's blue, okay, well what'd we get there? Well, you ended up with 6 ticks, right? If you were trailing with a stop, maybe your stop was over you got a little wick there, which is not a bad way to do it. You'll see these little wicks, which are pullbacks, good place for a trailing stop. Lots of different ways you can approach stop management. We're not really talking about that now, but what I want you to see are these areas of consolidation. So let's go back to here. We can go back to Friday. All right, so let me bring that down here. Now let's change the brick size. So I'm going to go from my median Renko. Now I'm going to go over to my UniRenko, which is my preference. So I have them all lined up here, both the median Renko as well as the UniRenko, so I can just quickly pop over here. I don't have to go to the data series and make that switch. I've got them preset, right, which is just inherent in Ninja. So now as we look at this day, you can see a couple of things. So a few things you'll notice pop up here. Within the paint bar scheme, we have built into this the ability to emphasize a bullish bar with a down close and a bearish bar with an up close, and that's we're highlighting here. Again, color choices are to your preference. I do it in a yellow and a green yellow here because I want them to be highlighted because that is a heads up to me in the market. So if we go back to the chart here, you'll note here often at either consolidation points or reversal points, you'll see that alert here. So we get so here we have we get an up bar here, but we get a down close. Here I get a down bar, but I get an up close, right? So it's just drawing my attention to that. So it's a bit of a heads up, like, hey, pay attention here because perhaps the market is transitioning. So you'll find that can be quite handy, and you'll see that they will very, very frequently be found right at reversal points. And again, I'm back to a 6-2 here. Let's go back a day and just Again, same thing overnight, right? Is that a transition? Are we just pulling back? Are we transitioning? Change of trend? Go back to Thursday. Again, you'll often see these at transition points, so that's why we built them in here. I want to draw your attention to those because that can be an alert. Here's a nice example here. We get this nice long trend here. I've got down bars with up closes. Does that mean the trend's over, we're reversing, or just pulling back? Well, note we don't actually get to a blue bar here. We threaten. Do you see what's happening? By going to the lighter blue, we're threatening to change the trend. Right, so here you can see where we go, yeah, we don't quite get there. Now we're threatening to get there, but we don't actually get there. Now we roll over, but we don't go directly to red because now we're transitioning back to the down bars, to the red bars. We can't get to red without going through this magenta. It's the transition. So what you're after here is not as much here. Well, you can just look at this and look at this. This is something most traders would identify. The length of the swings are shortening. Now we get, this one's a little bit longer, shorter, longer. They're getting shorter, and it looks like the trend is running out of steam. Now, again, I know it's always easy in hindsight. I get you. But swing, length of the swing, you might even be looking for a little divergence down here with some sort of a momentum indicator, whatever you're using for that. But right here, so as it sits right there, are we going down? Well, I would tell you right off the bat, that's one of the most dangerous places to enter the market, right? It's particularly in crude or gold or any of the New York markets where they're notorious for double bottoms. That would be a very, very dangerous place to enter the market, right? Now, again, I actually didn't know what was there, but my point being, you don't want to be entering, right? It would be a higher risk location to be entering on the breakout. So just that's my own opinion, right? So some people do just fine with breakout trades. I find that to be a dangerous place to enter the market because of the threat of a double top, double bottom. But once we get going here and we get into this, and I'll show you a few examples where we get through that potential threat of the double top, double bottom, which is always there, right? It's always there. Where you're right here, you say the same thing here. You can say, well, hey, do I take that trade? I might have a double top. Well, once we pass that pivot, okay, right? Same kind of thing. You can't eliminate it, right? It's always going to be a threat, but ideally you're entering that long down here, not right here. Or if you took this, that might be a trade you let go because you wouldn't have enough space. You'd be running into the initial balance low, which is potentially an area of resistance. But something like this, it's always going to be there, right? That threat of a double top is always there. There are other tools will introduce to you to help you identify whether or not you want that. And this could just be a stop run from stops that were sitting right there. Right? You think you're going, but note what happens. Now we've got, right? It's a potential reversal. Can't get there directly. I got a little consolidation. There's the break. See if there's any other examples here. This is, I'm going to emphasize this again because I had to deal with this, and this is much of the tools we built into this are because of this kind of a challenge right here. This, you can blow your entire day right there. If you're trying to anticipate where it's going, which to some degree we're always doing this, I understand that. But this kind of chop here, that can blow your entire day. You could be done trading for the day, right? You could blow through $1,000 there easily. So I want to emphasize that risk management here because we want to eliminate that, right? So again, you don't know when that's happening. Are we starting to go right there? Are we going? Looks like, hey, I got my blue bar. Well, what else is there? And of course, well, you'd have, I can't do it that way here because it's already broken it. You would have that threat. Oh, we're going right into the IB. Do I want to take that trade? Just things that Renko traders, to some degree, we're now delving into just the challenges all traders deal with here, but particular to the Renko brick. This is very problematic for the Renko trader. Easy after the fact, right? So the same kind of idea. These points of consolidation where you don't have any trend strength. All right, all of these throughout the course of the day are what we're trying to eliminate. Where's that strength of trend? It's the same thing down here. We were just looking at this. We're chopping here. Now, do we start to trend again? just these things that we have to deal with here as traders, and we're just making an effort to try and make that easier, to give you some visual clues to try and avoid some of that. No way to eliminate it entirely, obviously. I think that covers us on the paint bars and the different brick sizes here. So these are very much the kind of thing that I would encourage you to, if this is your first time looking at our Renko bar suite, to take the demo and work with it for a couple of days in sim, or if you're anxious to get into the market, work with the micros just until you get comfortable with the risk that is inherent in Renko bars, and you get dialed into the brick size that you're comfortable with, the bar type that you're comfortable with. Now, I prefer UniRenko, others may not. And then whether you want to, set it up much like I have here, where you have all of these different brick sizes, and whether you want the median Renko and the UniRenko. Now we're going to next transition into our newest addition to the lineup, which is the ATR mean Renko. So let's take a look at that. So the newest brick type that we've added to the suite here is an ATR based mean Renko. So I'm going to just click this on here because this is preset by default. So let's go look at it. So what we're doing here now is taking a 1 minute approximation. So we're trying to replicate a 1 minute chart. We're using the 14 period ATR to have the brick sizes automatically adjust to changes in volatility via the ATR. So the 114 is a good starting point, and you'll find that that's the default setting. Now you're going to notice that this is going to look a little different, because what's happening here, you'll see, as we have right off the open, as you can see, the volatility is increasing. We've got larger brick sizes here, very large. So note here, this little kickback is, there's a 12 tick kickback there. Yet again, right? This market's talking to you here. The market, what's happening there, right? So what's happening? We've had a swing and a retrace, and now carry on, right? But it just, in the context of our color coding of the bars, the trend is uninterrupted. We did not get a reversal bar. Now, same thing here. Those are big wicks that are turning back the other direction. There's a 9 tick wick. As volatility decreases, you'll note the bars are getting smaller and smaller. We get an increase in volatility here. We get a little pop in vol, and now they get smaller, smaller, smaller. Again, what you'll notice is that it's the retracements where you'll often see an increase in volatility. Once we're in trend, they tend to stay consistent. Now note here, we get very, very, very moderate. What's our brick size there? This gets really kind of tiny because the volatility dries up. Let's see if I can get it highlighted. So that's a 1 tick. Right? We have just absolutely no volatility here. Well, it's the end of the day. Going into the holiday weekend, let's go back to Thursday. Let's get it over here. Okay, so now you can see some real volatility changes. So strong trend here. We don't go to blue, but look, now we get some big vol at the low here. There's a 23 tick bar before I transition to blue, and then here's my big transition bar, and now it's tiny, 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 tiny. Note there's my potential reversal bar here as I get an up bar with a down close. Now we go back up here. Now very, very modest volatility here. It's middle of the day. The market's kind of quiet, and we end up the rest of the day with modest to moderate volatility. So it could be well below a 7.2. So the advantage here is that you no longer need to be pondering as to what the appropriate brick size is. You're not really referring to this in any way, because it's happening behind the scenes automatically. The software is doing it for you. So our indicator, we go back another day. This can be very appealing to people that don't like the idea of having to either guess about brick size, or they keep the same brick size all the time, which can be problematic as volatility increases and decreases. But it just is a more automated way to approach brick size calculation rather than use the ATR model that's running kind of manually, where it's getting you those 3 choices, then you're picking which one you'd like. Here you don't even need this, right? You wouldn't apply the brick size calculator to this particular brick size because this is not relevant here. It's happening automatically. So you wouldn't see, as we go from high volatility to slow volatility, you wouldn't see these changing necessarily, so they're no longer necessary on the chart. Oh, that's going to, I think, only back 3 days here. So, but again, kind of an interesting approach to it. So that covers all three bar types, and it's up to the individual trader what you're drawn to. Now, these are the ATRs are relatively new, so it's the kind of thing that you would want to test and just make a decision as to whether or not you're comfortable with that. That volatility-based brick size increase decrease, it's the same kind of idea. We're still trying to identify a lack of trend or a potential reversal point. Interesting, we don't get the little transition bar up here, but we do go from blue, of course, right? Blue, then we go to the magenta, then we get our red. We don't go to blue. Right, so the downtrend is just getting a retracement. Downtrend continues. Another retracement. Small brick sizes, small. All of a sudden, they're getting bigger because we're hitting increased volatility as we come down to this area, and it's not until this bar here where we have this giant increase in volatility here. Well, these bricks have gotten well, look at the difference, but are dramatically bigger here. If you're waiting for blue bars, well, here's your pullback, and then we get it, and now they shrink, and there's your potential heads up bar. Right? It's not necessarily, oh, I got to short it. It's just heads up. This trend may be running out of steam because now I've got an up bar via the new high, but a down close. Here I don't get it, but tight. Look how tiny these are. Very, very tiny. All right, so it's just another approach to risk management with regards to trading Renko bars that we think traders are going to enjoy the benefits that brings to you. Again, very, very individual choice as to what you want to use. So you'll note here, as we're going through the overnight, right, this is a fairly decent example, look how tiny the brick sizes are, right, because there's absolutely no volatility happening. Now we get to the open, right, now things start to heat up. All right, that covers our brick sizes. Now let's look at the backtesting features that are available to you with our tool suite here. So let's look at that. Okay, now if you're a trader who's interested in working with automation of some sort, whether it be a strategy that you built within Ninja or some sort of mechanical methodology, and you're interested in working with Renko bars, well, this is an important distinction. I'm going to show you in some detail here why this is important. So because of the way Renko bars are in effect smoothing the price action here by the way the bars are created, opened, and reversed, if you're running a strategy on this, the results can be quite deceptive. So let me give you an example here, and we'll look at them side by side. So if you, I'm just going to use a default Ninja strategy here, and I've already run it here because it takes just 20-30 seconds to run, so to not make you wait through that. So I'm going to just bring up here a strategy here. So this is a back test that I've run in crude here, so just as you're looking at here, and I'm just looking the most recent completed month, so start of May to the end of May in terms of trading days. And you'll note here I have the TDU Renko, and I'm just using the most basic back test scenario here, just a simple moving average cross. This is just the default, right? So 10.25. 7.2 over a month. Okay, well, so I've run that. Here are the results, and they at first glance look quite promising, right? 35.9. Now this would be plus trading costs. I don't have commission included in here, but you look at, hey, that's pretty good numbers here. I like the result of this. I think I'm going to trade this. Well, slow down, because what's inherent in this smoothing component that Renko gives us is that we don't get actual opens. So for back testing, these results are very misleading. So let me give you a bit of a side by side. So if I run the exact same strategy and I use our back testing bars, which you'll see here is the only difference between these two. Here I'm using the TDU Renko, here I'm using the TDU Renko back testing bars. So I can run this, and then I get an accurate result here of what that 1025 crossover would be. And you'll note, right, obviously very different results here. So this is negative 120, and that's prior to trading costs. So this would not be something you'd want to pursue, but it's very important that you don't get sucked into the idea, oh my God, I'm going to be rich by the end of the month. This is going to be easy, because this is not an accurate representation, and that has created a lot of problems for Renko system designers here or strategy builders that were unaware of this distinction. So let me show that to you on the chart so you understand the difference. So here's the 7-2, and all I'm going to do is I'm going to change the bar type from TDU-Renko to the TDU-Renko backtest. Now let me apply that, and then here's what the actual chart looks like with the true opens. So it looks very different, obviously, right? But if you're running a backtest, we don't want smoothing, we want actual results. So that is the actual fact of how this would look here. And if I bring this down here, it's deceptive. You look at the analysis like, oh, we got off to a great start. We didn't get to 35,000, but we were up in the positive, but then gave it all back over the 30-day period. So you end up right where you started. Something to keep in mind if you're a system designer, that this is a very powerful feature that we're including here. And of course, that's the same thing with the UniRenko. So if I were to switch these to, I got to do it this way. So I go to the data series and I switch this to the UniRenko backtest and apply that. You'll see the same kind of very odd looking chart here, because this is giving us the true open. So this would give you true results to that backtest. So just important if you're a strategy builder and you're interested in that type of trading, that you work with backtestable Renko bars rather than just the traditional Renko, whether it's our Renkos or anyone else's. Now, the one other thing that we built in here that I think is important to demonstrate is the ability to use these Renko bars with tick replay. So, for example, if you were interested in putting a footprint chart on top of, or I should say, applying a footprint chart to a Renko brick, well, you wouldn't be able to do that unless you had the ability to include the tick replay. So, our bars here, both the median and the UniRenko and the ATR Renko, I'll give you the ability to add the tick replay. So if you wanted to, whatever reason you had to want to enable tick replay, you now can do that on the Renko bars, right? All of our bars give you that option. So that's something to keep in mind if you're someone who's interested in working with that kind of specific application. Okay, and wrapping up, the last thing I wanted to show you here is the TDU order module here. Now this is specifically designed for Renko bar traders here. Now I'm going to show it to you here in terms of how you would apply that. Now additionally, I'm going to show you this. This would be kind of the building blocks of putting together a trading template, and I've applied here the Devil's Edge, one of our indicators here, because it has the TTM squeeze built into the center line. One of the nicest features here is one of my very favorite indicators. And I shouldn't assume people know what that is, but most of you probably will, as it's been around forever. But this was developed by John Carter of TTM, Trade the Market fame, very successful trader. But it's very clever. It's simple but incredibly effective. And that is, it's a measure of a reduction in volatility, as it's looking at the relationship between the Bollinger Bands, which are statistically based on standard deviations from a mean, and then the Keltner channels, which are based on volatility tied to the average true range. So a squeeze happens when the Bollinger Bands get inside of the Keltner channel. So we have a complete contraction of volatility. And I reference that here for you just to kind of demonstrate how the squeeze ties into our bar color. Some of the things that we were talking about earlier that are the challenges for Renko bar traders, where we have this lack of volatility, lack of trend, we just get into chop. Well, if you're applying something like a TTM squeeze here, or in conjunction with the other features that are built into the edge, this is an area to be avoiding, but it's almost more so, or equally as important, it's an area to be paying attention to, because you'll note here, in fact, the Devil's Edge kicks some signals out of here, some buy signals. When we come out of the squeeze, often that's followed by volatility, right? So we trend, we go into a squeeze, we consolidate, then we trend again, we come out of the squeeze, little baby squeeze here. So it's a nice feature, whether you're using ours via the Devil's Edge, or whether you've got your own squeeze indicator, or you're going to literally apply the Bollinger Bands and the Keltner channel to the chart. This is a very effective way, and it's a big heads up to, one, consider not trading, or if you're in a trade, maybe tighten up, because volatility is likely to follow. I mean, here being a couple of good examples. But once again, you'll note that very, very often you'll see the squeezes happening at the same time we're in the consolidation of the Renko bars, and we don't have trend established yet. We're in the chop bars. We aren't in bright blue. We aren't in dark red. We aren't in that trend phase. And often you'll find that will be accompanied by the squeeze to alert you that, first, I don't want to be entering the market during a squeeze, but if I come out of that squeeze, and this has an alert on it, when we come out of the squeeze, heads up, I may want to start looking at getting into the market. Now, as we relate to the order module, the way that you would use this here, now, of course, market's closed here on a Saturday, but what you'll see here, and this is actually, there's another brick. Well, here, let's see if I bring it down here, you can see it. So when the market's open, this would have your account number here, and this would be your ATM strategy, whatever you're applying, and then you pick whatever size, and you could customize. This could be 10, 20, 30, 40, whatever your size that you're typically trading. So if you put that here on this, now what that means when it's buy up, that means the next Renko brick. Remember the bar status indicator that we give to you here is telling you when you're going to get the reversal bar. Well, in this case, if you got a break here, that would be a continuation, so we'd get another red bar. We have to go this far to travel to get a reversal bar. Now, that's very powerful when you're in the midst of a trade and you're wondering, well, where do I want to put my stop? Well, you may or may not want to use the reversal, but that would be an area to consider. Right, and so for example, if you thought this, and we just, again, let's assume the market's open, and you thought we were heading lower here, we're going to go challenge that low, whatever the case may be, I could just hit sell down, right? So it's going to enter a market order here as soon as we trigger that next bar. So in this case, you'll note, right, as we went through before, I've got to get 2 ticks to get a new brick. The threshold is 2 ticks to get another bar. So it's 2 ticks to that level where I want to perhaps you want to enter if you're going short. Now the same thing, you could sell up. So you could hit a sell up. So if it goes up here, so for whatever reason, maybe that's there's a fib there, and you're saying, hey, if it goes up, I want to sell because I'm going to get right into that sell zone where I might have a reaction here, or an algorithm could be participating here. So if I get up there, I want to sell that on the anticipation that we're going to come from that zone, we're going to head towards that target. The other course is just buy sell market, right? If you're working on something and it starts to go, you just want to jump in, we're giving you that capability as well. And then of course you can cancel any orders that are on the screen. So that's a nice addition to the tool suite here, so you don't have to, this just will float on your chart. So you can attach it to whatever chart you're working on, keep it wherever you want, you want to put it over here. So you don't have to have the chart trader over here, you can just have this floating here and then just enter at the click of a button here, whatever you want to do. So that would give you, I think, a full look at the Renko tool suite. And just in closing, so if you wanted to see the full Renko suite, this is literally right from my trading chart. This is the Renko chart that I would use with all the things. Now, there's a lot on here that you won't recognize unless you've been through all of our tool suite. But you can see here. So of course, in the middle here, I have the devil's edge highlighting the squeeze that happens there. I'm running the ATR bars, right? So it's the bar bricks are changing based on that volatility. And there's some other things that are on here, which if you're interested in, then be sure to watch some of the training videos or the Renko tool suite where I go through all of this put together. You'll find it's very effective if you simply will follow. We've made it as easy to follow as we possibly can. All right, so when we're trending lower, even while here, right, we're getting these little pullbacks here. That's certainly, if you look at these, there's nothing here. If I switch to a crosshair, there's certainly nothing here to tell you to be a buyer here. Essentially, we've color coded it to make it almost impossible not to get the direction right. At least we made an effort here. So here would be a buy signal, right? That's the kind of thing to go through the Renko tool suite and some of the training on putting this all together into a package like this. But that's what my chart looks like. Okay, guys, there you go. That's probably plenty. A long video, I know, but a lot to cover in that. So if you're interested, of course, you can demo this particular tool suite as well as everything you see on the screen, because when you request a demo from us, we don't just send you one thing. We're not going to send you just the Renko tools. We're going to send you every indicator we make. So you could put this exact same template together, run it for 5 days, and that's 5 trading days, I should emphasize. Some people concerned that if they request it on a weekend, that Saturday and Sunday are going to be part of those 5 days. Now, it's 5 trading days. I think you'll find this, if you watch it for a day or two, to be a very effective way to approach trading the market. All right, with that, I'll wish you good luck. Remember, you can always reach out to us if you have questions, and just a reminder, a 5-day trial gets you access to all of our tools, full versions for 5 trading days. All right, guys, take it easy.